All right, sorry about that. Had to get the microphone set up correctly. And we are going to get into, we're still in chapter 8. Chapter 8 is about I'll just say it. It's about corporate strategy, diversification, and a multi-business company. All right, so where did I leave off of? Looks like right here. Yes. So we've been talking through this section about kind of the idea of the ants off matrix and then where do we go to expand? Where do we go to grow? Do we follow unrelated businesses and fully diversified businesses, or which is what your book calls it, is related businesses and unrelated businesses? Fine, whatever. We're talking about the same thing. Um, So throughout the entire thing, we're trying to explore, well, should we get into a diversified business line? And the answer usually is no. Now, I wanted to share with you guys because I've been wrong from time to time, although I don't feel like I've ever been wrong on this one. But I thought I'd go out and have a little bit of fun and went on to Chat GPT and I asked it, just out of curiosity, is it smart for a company to diversify into an unrelated business? Because again, when I read our textbook, it's like, well, sometimes, yeah, maybe we should. Yeah, it'd be okay. Well, maybe we should try it. But in most of the text I read, most of the people that do this for a living say no. In fact, avoid it at all cost. So here is the response. Chat gave me two different responses. Response number one: diversifying into an unrelated business, often called conglomerate diversification. Okay, that's what a conglomerate is usually, is owns and operates many businesses. Uh, the book is kind of arguing, well, sometimes they're in unrelated businesses. I would say most of them have their sustainable competitive advantage in their core competency usually threads through all of the businesses in one way, shape, or form. Usually, not always, but usually. Okay. So the first response chat, I suppose if a student was going to ask this question on an essay or an exam or something, here would be the response Chat GPT would tell you to put. So diversifying in an unrelated business, often called a conglomerate diversification, can be smart in some cases, but it's generally riskier and less likely to succeed than related diversification. Here are the pros and cons to help evaluate if it's a smart move. And then response two: diversifying in an unrelated business, known as a conglomerate diversification, can be smart in certain situations, but it also comes with significant risks. Whether it's a good idea depends on the company's goals, resources, management, capability, and market conditions. Okay. All of those very much related to and coincide with both our value chain and our supply chain. Um, so here are some potential advantages in the first one. Actually, I'm going to avoid the one on the left. They're both kind of saying the same things. They're just using different words, which I really like because if you were to take this class at the University of Minnesota, you might find very similar idea, but they might use a Wiley book or a Sage or some other book. And that school of thought is calling what we're talking about, which is the same thing. They're calling it something totally different. For example, a lot of us say income statement, but in the corporate world, it's almost always called a profit and loss. Okay. Almost always. And I know our accountants here at SDSU often say, no, we call it a P&L. Okay. Anyway, so on this one, is it smart to diversify in unrelated businesses? What might be some good reasons to do so, or smart reasons? One, risk reduction. Diversifying into an unrelated industry can spread risk, especially if the core business is cyclical or declining. Now, I would hit pause there. I would argue that if a company's business lines are declining, then maybe a somewhat related diversification might be wise because maybe there's a reason that industry or that product line is going away. Maybe you need to be shifting because the rest of the world is shifting and you're just not keeping up with it. So just thought I'd throw that in there. So for risk reduction. For example, a company in oil and gas might invest in renewable energy to hedge against long-term decline. Again, we're calling that unrelated. Those are not unrelated things, okay? Energy, you're still in the same sector, the energy sector. So I would argue that's not a unrelated business. Another reason to do that would be to utilize excess cash or sitting on too much money. Now, remember, when a company is trying to figure out if it's sitting on a bunch of cash, the cash can't just sit there. It has to be plowed back into something that earns a rate of return of slightly less than the cost of common stock. So let's jump up here earlier in the previous video. Oh, we're going to play this game, are we? Earlier, we were talking, we were Ford. We did a stock valuation of Tesla. When we did that, we had to figure out, based on a risk-adjusted basis, what is the rate of return we should be receiving if we are going to invest or buy Tesla stock. And based on risk, using a beta coefficient, a benchmark comparable return and a risk-free return, we need to receive, based on this level of risk, a rate of return around 19.17%. So that's pretty high. Okay. So if you're not able to receive that 19.717%, then you wouldn't go through with it. So in Tesla, if they were sitting on, let's say, well, hold on here. We'll see how big of a company they are. Trying to do my best, guys. Here, the screen keeps popping down on me and I can't see what I'm trying to point at. If you were to buy Tesla today, I didn't know that. They were, geez, a big company, which doesn't make any sense to me. If you were to go buy Tesla tomorrow and you had an extra $2 trillion sitting around, you could buy Tesla for 1.03 trillion. Okay. So if you're a Ford Motor Company and you got $5 trillion you're sitting on, the thing to remember is that money can't just sit there. It has to provide a rate of return of some sort. So I'm going to duplicate this. So we'll go back. We'll say we're Ford. We're trying to acquire, buy Tesla. Let me get to Ford. We're kind of living in the land of make-believe here. There we go. Now I would imagine Tesla is many, many times the size of Ford. Huh. Oh, nope, that is Tesla. We want Ford. Why are we not getting Ford? There we go. Yeah. Ford is only worth $41 billion. Tesla, $1 trillion. I don't know how that works and how that makes sense. I would have to imagine when I drive around South Dakota, I see Fords everywhere I turn. I see maybe 5 Teslas in all of Brookings with 25,000 people in it. So I don't understand that, but whatever. Okay. So if Ford wanted to buy Tesla and it was sitting on a spare $2 trillion because it doesn't want to blow all of it, Ford has the CFO, the agents have to assign a cost to capital of that money. That money just can't sit in a savings account. It has to earn a rate of return that is just slightly less than the cost of equity. The cost of equity is set by this capital asset pricing model amount. Okay. So Ford is still a large cap company. So we're going to leave that there. We're going to leave this there. We are going to change this for risk. So Ford Motor Company has a beta coefficient of 1.51. So we go back in here. We're going to subtract that out and do 1.51. We hit calculate. So their cost of equity, they have to provide a rate of return of 13.47%. So if the investors are looking at this company and the company is sitting on a couple $1 trillion, which I get, it's hard to fathom, but let's just say the CFO says, okay, that's not our money, that's the investor's money. But as long as we can provide a rate of return that is slightly less than that of the common stock. So if we can earn a rate of return of 13.2%, we'll just say, then it's fine to keep that money where it is. Why? because if we pay it out in the form of a dividend, it, it's as good to keep it in here earning about the same they would anyway, the same as our stock would, as opposed to paying it out. And now the investor has to figure out what am I going to do with all these dividend money. So that's why, and that's why we set the cost of capital for retained earnings is slightly less than the cost of equity. So in this case, 3.2%, something like that. All right. Where are we at here? Okay. So now we get into your book talks about a strategy of both investing in related and unrelated business lines. Again, I think the authors are going for more like kind of related and then very related as opposed to unrelated. That's my own opinion. Actually, and then let's go back to Chat GPT. Okay. So one of the reasons to do that is to use excess capital that you're sitting on. Okay. You have to get a rate of return on it. So the rate of return, if you were to buy, let's say, if you were to buy Tesla and you could receive a rate of return of 19 point whatever percent, that's more than 13%. Okay. Uh, those are both in vehicle companies. So there's a relationship there. They're not unrelated. Okay. Leverage of core competencies. Now, again, I don't see how that can be unrelated then. That's related. If the core competencies blend together, one feeds off the other, then you're not in an unrelated realm. Okay. There's knowledge there that can pass over. But that's one of the reasons to get into an unrelated business. Lastly, tax benefits. Sometimes if you sit on that money, or try to pay it out in the form of dividend, now everybody's got to pay tax on that money. The corporation does, the investor does, so on and so forth. So if a company sitting on a lot of cash goes and buys another company, well, then there's, I don't want to get in the formula for that, but there's tax benefits to doing so. Now, here are the downsides to investing or buying or getting into an unrelated business line. One, you lack the expertise to do so. Two, it can turn into a distraction. Why are you doing it? Are you doing it because it's growing, or it complements what you're currently working on? Or is this going to be a tail that wags the dog and management's going to be distracted? Then another disadvantage or downside is shareholder concern or investor skepticism. Investors may prefer to diversify their own portfolios and may view conglomerates as inefficient. And I would tell you right now, folks, that is how most investors view it. Conglomerates are inefficient. And we've watched this cycle of uh, large corporations go out and buy up all of these other companies with good reason. Many times they would be called related, but they go out and they buy these other companies and they realize this is not a good match, and they end up diversifying. And it's like, well, that buying and then selling another business can also be very inefficient because you're not focusing on making more money. So shareholders really, well, here it is. This can lead to lower stock valuations, um, conglomerate discount. When we look at a valuation, the higher the rate of return means the bigger the discount. So what it's saying there is when a company starts trying to get into unrelated businesses, stockholders, the principals, the owners are going to start valuing the business lower. So the rate of return is going to go up, which because the risk is going to go up because the knowledge of how to do this has gone down. Well, what does that do to the stock price? Well, if we leave everything the same, okay, um, yeah, let's do it this way. We're going to do a beta coefficient of 1. We're going to arrow over. We're going to try to standardize this. We're just going to mess with the risk-adjusted discount rate. So we're going to take earnings are expected to grow at a rate of, let's do 9% a year annually until leveling off at 3%. And we'll leave the risk-adjusted discount rate right now at 13.47. Um, that doesn't sound right. There we go. Okay, let's try that again. $5 expected to grow at the rate of 9% for the next 5 years until leveling off to 3% at a risk adjusted rate of return of 10.4%. You're probably mentally figuring out the calculation, the previous CAPM calculation. So we hit calculate. We have a stock value based on receiving an earnings of $5 a share that grows annually for the next 50 years, for the next 5 years, and then levels off for the next 50 years at 3%. You should receive a stock price for that of $89.36. Okay. Now let's go and let's add risk. So instead of one, we're going to go 1.4. Okay. So risk went up. So all of a sudden things start fluctuating more and we can't control things as much. The risk goes up. We're unsure. We don't know what's going to happen next. So we can't forecast anything. So the beta coefficient goes up because risk went up. We hit calculate. Now you have a risk adjusted discount rate that just went up. You don't want that rate in this calculation to go up because watch what it does to the stock price when we leave everything the same. So beforehand, we had a stock price of $89. We've increased the level of risk, which forces us to have a higher rate of return for the investment. Okay, keep it $5, 9% before leveling off to 3%. The discount rate's now 12.8. There you go. So when risk goes up, it means the stock price goes down. You don't want the stock price to go down when you're running the company. That means you're taking a valued asset and you're now selling it or able to sell it for less than what you were able to sell it because you increased risk inadvertently for probably the wrong things. Okay, so that's what we're talking about. Let's go back to Chat GPT. Okay. So shareholders, when risk goes up, that means that they require more of a rate of return, which doesn't mean they're actually getting any money back from the company. It means that the stock price goes down because they're valuing it less than they had before to account for that level of risk. One of the big reasons often getting an unrelated businesses also doesn't work is you have a cultural clash. Okay. Then they talk about famous examples of when a company got into an unrelated business. And I noticed both of them talk about Berkshire Hathaway. Warren Buffett, one of the richest men in the world, I think he's worth about $100 billion, famously the best investor in the world started a mutual fund where he went in and bought companies and businesses and held those businesses. And these were usually very well run businesses that happened to be undervalued. If we go back to the capital asset pricing model, if you look over here or the valuation, the DCF calculator, if you go down here, you can see the Warren Buffett formula for investing. To cut to the chase, it is the same thing we have done. I'll just go back, except they add in a confidence interval. So Buffett does the same exact thing we were just doing, except he says, how likely do I think this is to materialize? And if it's 80%, he'll put that in. Well, that will discount the discount rate. If he can still get the business for less than his valuation rate, then he'll go buy the asset. He'll go buy the business. Now, here's my point. Warren Buffett is his core competency is investing. He is the investor. He's the best asset allocator in the world, or that's actually what he says. I can allocate assets better than anyone else. That is not the same thing as General Electric. When General Electric or 3M tries to do portfolio management like Warren Buffett does, it's not the same thing. Okay. So I think that's a really, really bad example of Chat GPT because his whole name of the game is investing. He is the principal. So that doesn't work. They also put over here Amazon and General Electric historically. No, there were a lot of core competencies in most of the investments. If you read any of Jack Welch's work, and then Jeffrey Immelt was the CEO after him, and I don't know who it is now. But then it talks about failures. Okay. Now, then it goes to this when it might be smart. A smart strategy only if you have strong leadership and capital allocation skills. That's what I was saying. Warren Buffett has those skills. Jeff Immelt or Jack Welch are not financial gurus. They're petroleum engineers, okay? Not the same thing. The target business has a high potential and it's undervalued, okay? So if it's seriously undervalued, then and it's unrelated, you have good leadership, you might be able to pull it off, but probably not. It would help you to stabilize revenue streams. I would argue that's okay if the industry you're in is dying and it's going away. Um, and the company is prepared to invest heavily in acquiring new capabilities. So you have a learning curve here that makes it so it doesn't make sense. The bottom line, now we're talking. Usually it's not smart unless you're a rare company with an exceptional management resource and strategy. Most companies are better off focusing on related diversification or deepening their core competencies. Here, bottom line, it can be smart if the company has a clear strategic reason, strong management, and understands the new industry. Again, now then we have some relation. Okay, there's a knowledge that you possess. But without these, it's often better to stick with related diversification and reinvest in the core business. Would you like a short checklist? No. Okay. So again, I was thinking, well, maybe I don't know what I'm talking about. I'll go on ChatGPT, see what that says, see what artificial intelligence says. And I felt very comfortable that it was saying the exact same thing I was saying. Again, the reason I'm bringing all that up is because your textbook is, and I like the text. I actually like textbooks that I can argue with. It makes this a lot more fun. I'm sure more fun for you guys to listen to, is me arguing something versus just reading off a screen. So, uh, your textbook argues for it. I'm arguing completely against it. It sounds like 9 times out of 10, you better stick with related businesses. Okay. Um, so diversifying in both related and unrelated businesses, they give you some definitions. You have the dominant business enterprise. So you would have a company that has one major core business, which accounts for 50 to 80% of the total revenue, and a collection of small related or unrelated business accounts for the remainder. So it has one core thing it does or produces, and it dabbles in other things. Okay. You have a narrowly diversified firms, okay? Diversification into a few, like 2 to 5 related or unrelated businesses. Again, this would be like a specialty company that manufactures or produces something. And then they come to find out like competitors are starting to sell out because maybe the owners are getting old and they don't want the business anymore. So they would dive into and buy up those other competitors simply because it's then they control the whole market. Broadly diversified firms, diversification includes a wide collection of either related or unrelated businesses or mixture of both diversified and undiversified or related and unrelated businesses. Um, I can't think of a company that really is in that diversified. There are, okay, Disney, trying to think, Amazon. I'm trying to think of others. One of the things to take note, especially with like Jeff Bezos, very similar to Warren Buffett. Jeff Bezos was not he's not a computer programmer. Jeff Bezos worked for a private equity firm, a hedge fund, basically, to invest money into businesses. So that is someone that views the world much more like a Warren Buffett would compared to somebody like a Tim Cook at Apple. Okay, so when you see Jeff Bezos taking over the world, that makes a little bit more sense, especially if he's getting into unrelated things, because, well, because he knows what to watch out for. That might be a better way to say that one. And then you have the multi-business enterprise. So you have a diversification into several unrelated groups or related businesses. Again, I don't see a lot of examples they're giving for these, and I don't think I'll test you on that. Here we're talking about how do you evaluate the strategy of a diversified company, and they talk about steps. I'm trying to think. Here they're just using a priority matrix or Pareto or yeah, I'm trying to think if Pareto is the right thing, a weighted matrix. So some things you'd want to look at is at a for a company that is in unrelated or various related and unrelated business lines. Assess the attractiveness of the industry the company has diversified into. Assess the competitive strength of the company's business units. Evaluate the extent of cross-business strategic fit along the value chains of the company in various business units. 4, check whether a company's resources fit the requirements of its present business lineup. 5, rank the performance of the business from best to worst and determine a priority for allocating resources. And step 6, craft a new strategy moves to improve overall corporate performance. I'm actually going to put a couple of big, I think we're going to have that maybe turn into a project paper. I was planning on doing this anyway, guys. Um, but I kind of like the outline of that. I will put out a separate document that will tell you as a final project portfolio thing that I'll have you do. It will ask you to do something like this. When you do it, I'm going to have you do a valuation, a stock valuation. We're going to use publicly traded companies unless you've taken a couple other classes with me and know how to evaluate a private business. It's just easier to do publicly traded and large cap companies, frankly. But this is the analysis of uh, the strategic, the strategy, not strategic, the strategy of a company that's in multiple different types of businesses. Um, One of the things they talk about is trying to, how do you analyze the industry with which you want to get into? And this is breaks out steps one, two, three, four, five, six, and seven. Um, I think I'm gonna go ahead and stop this video and oh boy, yep, we're gonna get into a fourth video. Um, or a part four, because I think, yeah, I might turn this into your final project portfolio. We'll see. Anyway, we'll see you in the next video. It'll be chapter 8, part 4, I believe. Keep it real, yo.